To my far right is Coy Garrison, Deputy General Counsel, Crypto at Robinhood. I loved your movie, Coy. Rick Geloff is going to join us at 2 o'clock. He's Chief Innovation Officer at the Bank of North Dakota, which is an interesting story. I hope he'll have a chance to tell. Sarah Jane Hughes, my friend, from the University Scholar and Fellow in Commercial Law, Maurer School of Law at Indiana University. Sarah Jane is one of the world's experts on anything you want to know. To my right, Amy Ledig, Vice President, Capital Accounting and Finance Policy at the ICBA, a wonderful former client of mine. And to my left, an old friend I've worked with many times, Peter Wehner, technology consultant, journalist, author of The Disappearing Cryptography. So I want to start with JP kicking this off and getting this panel to talk about stablecoins, tokenized deposits, where the money is, how the money is, and how this is all going to work. JP?
Firstly, I wanted to say how lucky we are that Tom is still here, because after doing that hand demonstration with Yelena, Tom's gotten calls from 5 or 6 agents to move immediately to Hollywood.
You ever see the Seinfeld one where George became a hand model? Yes. Yeah, that's what I'm hoping for.
So thank you for staying in the afternoon, Tom.
It's okay.
So Coy, what is Robinhood doing in the crypto space, and how is it thinking about equity tokenization?
Yeah, thanks. So Robinhood, views crypto as a significant part of its business. It's about 20% of our revenues. We hold about $38 billion worth of crypto on behalf of customers. So it is, there's a lot of discussion I've heard earlier today that maybe is more academic or philosophical, like should this exist? How's this doing? But we're an example of a regulated entity that is providing access to crypto to their customers in a responsible way, right? So we're regulated in the U.S. through a couple different ways. The New York Department of Financial Services granted us a BIT license and is our primary regulator. We're registered as a money services business with FinCEN, right? So we comply with the BSA obligations and everything like that. We're a global entity, so we acquired Bitstamp, which is a crypto exchange based in Europe about a year ago, a little over a year ago. So we operate under 2 different MiFID licenses in Europe, as well as a MiCA license and the like. So we view crypto as something that is an integral part of our business, and it will be for quite some time. Tokenization, in particular, equity tokenization, is extremely exciting to us. It really serves as a bridge between our crypto business and our brokerage business. I like to think of tokenization as it is the opportunity for us to modernize and dramatically enhance our legacy market infrastructure. A lot of the stuff that's super exciting, you might not see. It's all behind the scenes. Our existing equity market structure is very complicated. It has many intermediaries. It's not the most efficient in the world. Tokenization and blockchain technology allows a lot of those inefficiencies to be eliminated. So what might that look like for the end user? Well, it unlocks 24/7 trading. It unlocks instantaneous settlement. There's a lot of exciting things that I think people will see of, oh wow, this actually is a benefit. But that change is not going to happen overnight in the U.S. Our markets are, the crown jewels of the U.S. capital markets are the equity markets. So we're proceeding with care and carefully coordinating with the SEC on our plans of how this could happen. A lot of other market participants are doing the same. I know it seems like every day there's a new announcement out of the SEC of a no action letter or a rule change being approved. And finally, I'll stop rambling here, but it's important to realize tokenization will look different in different jurisdictions. So in Europe, the same technological benefits of tokenization are there, but they have a different structure. So we actually offer stock tokens to European customers through our MiFID and our MiFID licensed entities. And those are derivative instruments, right, that they're really attractive to European customers because it allows them to get access to US stocks. That model may not necessarily work in the US, right? So it really is a bespoke situation of each jurisdiction. What do the rules allow for, and what is the real benefit and use case for that jurisdiction?
Thank you.
Sarah Jane is the person I always call when I have a payments question or a UCC question. I didn't do too good on the UCC in law school. So we seem to be in an era where we rush things to market and we try to fix them later. And the question is, are some of these things fixable? And the question becomes more acute when you talk about tokenization. So you and I have talked about some of these issues. Talk about tokenization and, for example, open banking and the issues that are raised there, and privacy protections, things like that.
So that's 3 questions, right?
Yeah.
Okay. First one is taking an
Is her mic on?
I don't think-
No. It's on now.
Okay, on now?
No.
Yeah, we'll trade. Come on. So the tokenization piece of this is central to all of the questions you just asked me, I think. So there are many benefits of tokenization. And the problem is that we've been talking a lot about the benefits. We haven't yet in payments, equities, I think, being quite different. In payments, tokenization makes it more complicated to achieve some things that we're already requiring competitors who are not going to use tokenization. Or imagine, how many of you are bankers? Just regular bankers, please? Oh, they all went home before lunch. All right, so a couple over here. I've got bankers over here. What I want to know first is, how do you imagine, or do you imagine, that you will have one set of untokenized deposits and another set of tokenized deposits? Because I don't know the answer to that question. To me, that is an incredibly important question for how banks are going to manage this transition, leaving Tom's 2 other questions aside for a minute. So the other thing that worries me about this, or makes me curious about this, is someone tries to deposit a tokenized deposit to a bank that doesn't have tokenization capacity. And this is something that's been going on for a long time, because not every bank has a real back office. Not every bank could afford a real back office. But there are so many pieces of doing that. And that attempt to deposit a tokenized deposit at a bank that doesn't have that facility is going to stop, and people's expectations will be damaged. So that's one of the things that I think about in this area. Second is privacy. Well, tokenized deposits should be very private. Now, the Genius Act, rather, has provisions that say you're going to have the ability for us to monitor your BSA AML compliance. There's going to have to be some other checks to be sure that you're not dealing with persons who own the assets being deposited that we're not supposed to do business with. That is going to be hard at one level, possibly impossible, but I haven't figured that out yet. And I think it's very important that that subject gets studied by us at this time. And then the third question, in reverse order, if I'm correct, was, Tom, it went. What was the third part?
Open banking?
Oh, yeah, open banking. So a tokenized deposit has a different information trail maybe associated with it. And if the tokenized deposit does not come from a US-centered financial institution, we're going to have to develop protocols for handling that sort of privacy issue. How many of you, well, I'm old enough to remember almost when the Bank Secrecy Act was passed. I think I was in college. And I remember the beginning of Reg E, and I worked on Check 21 and all sorts, and the revisions of the Uniform Commercial Code several different times. Whenever you have a massive change, and I think tokenized deposits will prove to be a bigger challenge than we'd like to think they will be, we have 2 problems. And I mentioned this quietly, but I will now mention. When you have 2 regulatory structures in place or about to be in place at the same time, in following the Truth in Lending Simplification Act of 1981, Congress asked the Federal Trade Commission, where I worked, and the Federal Reserve to study what it would cost to implement the new requirements of the new act. And the answer was, year one, it would cost twice as much. You'd have to have all your old systems in place, and you'd be working on creating and implementing your new systems. So the same thing will happen with open banking in some respects, and some of you may already be dealing with that. The second thing, though, is, and some of these were longer-term obligations where you can't do a change in terms notice as a bank or as a credit card issuer, for example, and have it be good in 30 days. If you have a mortgage transaction, I'm sorry, Rod is not in my line of sight for him to help answer this question, that goes on for 30 years, and this change happens when you're 5 years into it. Your cost doesn't go back down to what it was before the implementation date. It goes down as those longer-term obligations get repaid, and that customer is moved to a new product with the new regulatory system. This is a really big problem. And so for open banking purposes, I hesitate to ask how many of you would jump at giving a third party whose providers you don't know, this is a problem for you, would jump at giving your banking information out. And I'm not persuaded, never having worked for a bank, but having worked as a financial regulator briefly and having taught it for a long time. In 1976, the Supreme Court said the bank owns the information. You don't really have a privacy interest in it. And open banking turns that system that we've had in place now 50 years on its head. So then the question is, the one about the providers, not about whether I trust Robinhood. It's whether I know who your providers are and I can trust them, or that you have enough firepower to be sure that I can trust them. You probably do. Some people won't. So what I want us to think about is, this is a lot of change happening at the same time. It's about banking records, which I guard very carefully, about privacy, about multiplicity of regulations, and some other things that in our rush to join and to be cool, we need to take 2 steps back and think through how, because I care, how it affects the banking system and how it affects other people who provide valuable services. Consumers, especially young consumers, or my law students just love it. They want to do all these cool things. Are we ready for all the cool things? We have to be ready. So we have to figure out what we're going to do to make that happen. Boy, that was a long answer. I'm sorry.
That's all right. We'll debit you in the future.
Debit.
Okay.
Amy, how do you see stablecoins impacting deposit bases for community banks? And what does it mean for local lending?
Well, as Sarah Jane said, there's a lot of change happening very quickly here, and I think that, as I've joined ICBA over the last year and talked to community bankers across the country, there's a lot of concern about how these changes are rolled out and, who will wind up paying the price when things break in the name of innovation. Treasury has estimated that we might go from 300 billion in stablecoins roughly to $1 trillion by the end of the decade, which is a huge explosion in a very short amount of time. And research from ICBA, from other sources, suggests that a big chunk of that could come from community bank deposits. And part of the issue with this is not competition. Community banks have been around for over 200 years, are used to competition, are open to it. But the question is, what price do Americans and Main Street economies wind up paying if there's that sort of disintermediation and deposit flight? The role that community banks play is really unique. The U.S. Financial system is unique in having community banks in the first place. A lot of other countries don't have this type of setup. And the role that these institutions play in their local economies is really, really critical and, in my opinion, irreplaceable. About 60% of small business loans that are under $1 million are made by community banks. 80% of the banking industry's agricultural lending is done by community banks. 70% of bank branches in rural areas are community banks. So this is both a footprint and a level of credit availability that's not easily replaceable if community banks are disintermediated by particularly yield-bearing stablecoins. So I think we really have been urging policymakers on the Hill and across, the agencies to keep that in mind in terms of, okay, what does this look like? We support efforts to sort of experiment with stablecoins and see what opportunities are there, but realizing their potential as a payment mechanism, not a store of value, they are designed to be a payment mechanism, realizing that potential shouldn't come at the cost of community banks and the Americans that they serve.
Peter, we raised some questions before, and I asked a question which was really a trick question. How many people in the audience are dying to use stablecoin, understanding that stablecoins will probably more be a commercial business-to-business tool than anything else. But it does make the point that we are changing inbred and well-created systems that have been around a long time and moving towards tokenization and essentially trying to replace existing infrastructures with tokens, almost at every level. And the question I have for you as a technologist and journalist who's followed this stuff for a long time, what are we achieving in doing this? I mean, whose interests are we serving? Is it really moving the public policy ball forward? And if so, how?
It's a fair question, and I like the fact that you use the verb achieve in there, because in the end, we're just taking one ledger with credits and debits and replacing it with this new whiz-bang ledger that also has credits and debits. But there are some differences, and a lot of it depends how we do it. Even though people talk about blockchain and they talk about Bitcoin, and that's kind of the one thing that everyone views as the kind of canonical thing, there are lots of differences of how we might implement it. But I think you can look at this and you can say the whiz-bang ledger, if it's going to be a lot like Bitcoin or Ethereum, it's going to have some of these differences. And so one of the things that may happen is that a lot of the transactions will be public. Maybe not the name, but at least the fact that the transaction happened. So if you go, there are a number of these companies that have sprung up, like that do chain analytics. And what they'll do is they'll go and they'll say, oh, this is how this money or these Bitcoins flowed throughout the chain, or who they traded and then where they went after that and things like that. And sometimes they find interesting patterns and they report interesting things. I really like the fact that we opened up this whole meeting talking just about Bernie Madoff, because like Tom talks about what we achieved, and one of the questions was, he claimed he had 40,000 shares of, I don't know, IBM or whatever, and he really had 400 or whatever the auditors found. That's because everything back then was secret, and so Bernie's ledger was secret. It's entirely possible that if we move to this completely tokenized environment, there's going to be a lot more information that's out there, and maybe some citizen auditor out there is going to poke in, and they're going to have enough information to have an interesting insight or a useful insight. So we might be bringing a lot more eyes to what's going on. I think when it comes down to it, that could be the biggest distinction.
Thank you. Rick, welcome from North Dakota. Can you please describe Bank of North Dakota and what makes Bank of North Dakota different from other banks?
Yeah, thanks for having me, first and foremost. Bank of North Dakota has been around for 107 years. We're the only state-owned bank in the country. And so we're very unique in the aspect that we provide services, correspondent services out to all of our financial institutions that we partner with. These uniquenesses allow us to do maybe some more creative things with the help of our governing body, the Industrial Commission, and our advisory board, as well as the North Dakota Department of Financial Institution. As the Genius Act had come along, we really wanted to make sure that we could keep our financial institutions and the amount of financial institutions that we have in North Dakota really stout. And in order to do that, we felt like it was our job to come in and educate and make sure that people were understanding that stablecoins, when the Genius Act passed, really said that things weren't going away. And so we need to be educated. And we took that as our primary role, was to educate along these lines. as we continue to move on, and I'm sure you're going to ask more questions, but obviously we've come up with a partnership that allows us to do Rough Rider coin as we continue to look to see how we can provide services to those North Dakota financial institutions.
Thank you. Can you perhaps expand upon one aspect is how you see how is Bank of North Dakota's role in comparison to other financial institutions in the state or community banks?
Yeah, so they're all front-facing customer banks. We don't compete. So one of our founding documents was that we would not compete with any financial institution inside of North Dakota. Well, we are instead mandated to cooperate and assist those financial institutions. We felt like this digital transformation that we are undergoing, it's part of our responsibility to make sure that they're educated, that we're providing services, and that's really what separates us. Now, the one area that we do maybe some direct stuff to consumers is student loans. We have about $1 billion student loan portfolio, but the only reason that we're in that is because nobody else in the state wanted to do that. So we said, hey, we're going to step up in this area. And that's really the premise about the Bank of North Dakota is we step up in different areas that maybe our financial institutions don't want to get into, or they feel like there's some risk. And so a largest portion of our portfolio is participation loans, much like a correspondent. But we offer treasury management services, safekeeping, other things to our North Dakota FIs. And that's credit unions and banks.
Thank you.
Peter, we've talked a bit today about how the markets are changing and how we seem to be thinking about going back 130 years to systems that were extant at that time, which means eliminating trusted intermediaries, segmented forms of money. And the question I have for you are we inevitably, and look, you're probably the only person in the room who understands Bitcoin, understands how to decipher it, can trace it, understand the underlying technology there of the blockchain. And the question I have, are we eventually moving to decentralized systems? And understanding all that that means to the way that these things work. And it seems to me a unique movement, given the fact that everybody has fought so hard over the last few years to have the government backstop them when they get into trouble. And so we seem to be swimming upstream in terms of that. And that, of course, leads to the whole question of asymmetrical regulation. I mean, if you want to be backed by the United States government, you got to be regulated, right? And so what do you think of these decentralized mechanisms, organizations, and structures? And is this the future?
Yeah, so this is a deep kind of question about really the politics who run it. So in essence, you're not going from like one with trusted intermediaries to one with untrusted ones. It is actually interesting mathematically how they've encoded and forced a lot of trust in the updating of the ledger. So in a sense, we've taken all these regulations and we've reduced them to these algorithms. And then when the Bitcoin or any of the blockchains is updated, it should all be, in theory, completely correct. So we've kind of replaced all of the trustingness with an algorithm. So that's kind of wonderful in a way. However, what's been driving it, I think, is I guess the central part of your question is about decentralization. That was always the dream that people were selling this at the beginning, and one of the ironic details is that a lot of the chains have become very centralized, just the same way that every industry evolves, where there's just one low-cost producer, and that one-cost producer ends up dominating. And so when you look at the people, at the beginning, the Bitcoin blockchain may have been updated by, hundreds, thousands of people, even when there aren't that many people involved in it. Now there really are just, several mining cartels that completely control it. And so when you have a blockchain that's designed like the Bitcoin one, the ability to do low-cost mining is the one that ends up winning. So, if you're just focusing on the decentralization aspect, what's going to happen is there's going to be a low-cost producer that wins. If you're talking about the government aspect and the trusted regulators, I think it's one of the real questions. One of the things that's driving people is they don't necessarily trust the government. And you can ask the truckers in Canada, for instance, or you can ask the people. And it really, I think the banking industry made a huge mistake by debanking the people in Silicon Valley, because that just made them really angry, and they realized how untrustworthy the system is. So, that's something that has to be worked out and has to be figured out. But to get to that point, will take a lot of negotiations, I suppose.
Can I weigh in on that?
Yeah,
Yeah,
absolutely, please.
I thought those were great points. I mean, I think it's also important. I don't view it as a black and white decision of pure decentralized world versus centralized intermediaries, right? I mean, I think we're a good example of Robinhood. We're very interested in participating in decentralized exchanges, allowing our customers to access certain opportunities that are not available with centralized intermediaries, right? But we're looking to do that in a responsible way, and we have regulations we have to comply with, and we're not alone in that. There's a lot of regulated intermediaries that are interacting with DeFi in different ways and finding ways for their customers to do that. So I think you will increasingly see that in the future, and that's one of the hot issues under the debate of the Clarity Act, right? Is the SEC and CFTC need to fine-tooth define when do these decentralized exchanges, wallets, when does that activity trigger any registration obligations if they do under those different regimes. And I think that process is playing out, and it's a good process to play out.
Peter, let me come back. I'm going to ask you a question on the follow-up here, and that is, depending on who you read, and you can research this, there's somewhere between 12,000 and 24,000 different cryptocurrencies. I guess Bitcoin is probably the leader in terms of being the poster child for cryptocurrencies. It's got this 21 million cap, right? Which arguably, and I don't think it's entirely true, makes it scarce. But I guess the question that I have is, where do all these cryptocurrencies go? I mean, how do we support 24,000 cryptocurrencies? And what does that mean for the future of the market if, in fact, we are going to have these crypto markets and we are going to have these decentralized? How many of these can we have?
I mean, that's really for the market to decide, but I mean, where are they going to go? Almost all of them will go to zero. I mean, there's just, and I think it's one of the real problems for the whole industry, you might say, because people can always just create another one. So like you were talking about Bitcoin having this implied scarcity. And if you've just got some rando coin, it's very possible for someone to come and create rando 2 and rando 3. And we could do it with a laptop right here. So I think that is like one of the weakest parts. And when I think about it philosophically, I feel like we almost need to completely rebuild everything we learned in economics and economics theory, because that's all built around scarcity. And the reality is, in this digital world, we have such digital abundance that all the old rules and all the old ways of thinking from economics just don't apply. So in the long term, I don't know how that's going to work. Now, from a practical standpoint, what can happen is that a lot of the tokens that people create are actually tied to some good or service. So you'll see there's a restaurateur in Chicago who is not exactly tokenizing it, but he's just selling in advance a ticket to have dinner on a certain night, and these kind of trade, or people can share them. So he's just changing the model of going to the restaurant. So if people are creating tokens that are tied to some other good and services, those don't necessarily need to go to zero unless there's something happens with the service. So those are the ones I think that will survive and be interesting and be useful to people in the future.
Yeah. JP, I just have one other question for Peter in terms of my own personal curiosity. Is the price of minting getting close to the market value of a Bitcoin?
I've heard that, and when they designed it, they put in a little dial that would adjust with time, but it's essentially just pegged to the cost of energy. And you'll see that the people who are the most corrupt are the ones that are essentially stealing energy from someone at a lower price. So it's at least with Bitcoin and their whole proof of work process. Ethereum is different.
So I should watch for people trying to plug into my outdoor outlets?
Well, I mean, it's gonna, right, you should, and universities have had problems where, kids were running mining operations in their dorm room because they're not built for electricity. And that's not uncommon. You hear stories in some governmental systems where, because of the way the system works, they're not, some part of the corner of the place doesn't pay their electric bill. Well, they were mining, Bitcoin.
Okay. Sorry, JP.
Coy, what's Robinhood's perspective on tokenizing RWAs?
Sure. So, I mean, real world assets can mean a lot of different things. It can mean essentially anything you want it to be, right? I mean, I think at its core, tokenization of any private asset that people want access to is an encouraging thing. It's a great technology that can pretty much instantaneously add liquidity and transparency into a market that has previously been opaque, right? And along the same lines of that, or it's important to remember, like the regulatory structure of that underlying real world asset will still have to apply in some way to the tokenized instrument, right? So it's not as easy of, the technology just immediately unlocks it. For example, private securities, right, that currently are only available to accredited investors or those with certain sophistications. Tokenization has the ability to make it so that it can be more freely transferable. Others have access that information asymmetries can be broken down, but until definitions like the accredited investor definition are changed, that's going to be a difficult lift, right? So I think that the technology is knocking on the door and maybe putting a mirror up to certain regulations that the SEC has held on to for 30, 40 years, that it's probably time to modernize.
Just to show you how boring I am, Sarah Jane, I'm going to ask you a question, a legal question. Well, it's a business question that has legal permutations, and I think the nuances to this question are a millionfold. And that is, what does tokenization do to the debtor-creditor relationship? I mean, who's a holder in due course under the UCC?
Okay, so the debtor-creditor relationship and holder in due course are really two very different things. Right. And holder in due course is very old, just like the debtor-creditor relationship. So if you could instantaneously move the token into the hands of somebody else in a different jurisdiction, et cetera, I think it could be very difficult. That means that Coy, or one of you, will have to find a way to lock down the token that is serving as collateral for you. And there's a separate piece of the debtor-creditor relationship that the FDIC is really largely responsible for, which is when you put your money in the bank, it's the bank's money, it's no longer yours. When I explain this to students, they turn pale shades of gray. And they say, wait, what? It's not my money. I said, no, the bank owes you the money back. Just like with payment stablecoins, there will be a right to redeem. The FDIC is backing up the right to redeem in this case. And the question is, the reserves will be backing up the right to redeem in a payment stablecoin. So that's a very big difference in how this is going to work. The reserves being in banks, that's a good thing, or being in other high quality assets will also be good, although banks, because the FDIC is here, is probably going to be a very good thing for many people, and people might even choose a provider on the basis of where the reserves are going to be. So, holder in due course. When I trade, or could trade, a Bitcoin, and the miner group that's doing all the verification says, yep, you're giving up your rights, we're moving that item to a new space with a new owner. That's sort of like holder in due course, where the English used to say that the obligation should be pure, just money, no other conditions, nothing else that gets in the way of the person who has it, assuming they received it through a process called negotiation as opposed to transfer. All my rights transfer to Coy, and he can do it back if he wants. So when we have this, we no longer can count on the same rules because they're not written yet, applying in the case of transferring a tokenized deposit, or at least that's the way I have been conceiving of it. That's a really big problem, especially in an environment where one of the functional reasons to have tokenized deposits is speed of delivery. So you get delivery, you got to transfer, but you may not have a full negotiation, even though that happens because it's happening outside a system that may have to clear it. And when I first started teaching, someone from a law firm in Indianapolis asked me what I was going to teach, and I said, negotiable instruments. And first the man coughed, and then he turned a very pale shade, and then he wandered off because he didn't want to talk to anybody who could talk about who was a holder in due course. It's still really important in our system to be able to do that. And when did we find it out? During the financial crisis, and particularly people who held securitized interests were trying to foreclose on homes. And they could not prove a chain, now this is different with tokenized, they could not prove a chain of transfers that qualified as negotiations to make them proper plaintiffs in foreclosure actions. And that was really good thing if you were the homeowner resisting being foreclosed on, and a really bad thing. And what I concluded was that the people who wrote those instruments never took negotiable instruments and never studied local real estate law. So if you're hiring people, pay attention to whether they took property and real estate law and some other things, because in the banking industry, in the securities industry likewise, but for slightly different reasons, you're still going to want to know that they have the sophistication to write something for you that's actually going to work through these ancient pitfalls. And we have not figured that out in this environment yet, unless you believe that the verification that's happening at Bitcoin can be transported to all of these other environments, and I'm not there yet.
You know, the key here I want to emphasize is understanding these issues. They're all resolvable, and they'll be resolved. If you don't see them, you can't resolve them. That's the problem. And from a business perspective, you don't really want to be in the class that doesn't resolve these issues, because they remind me, Sarah Jane, of where we were in the 1990s when electronic commerce, as we called it then, or online commerce started, and all state laws required for a contract an instrument with four corners and a wet signature. And we said, well, wait a minute. There's no wet signature on an online commerce transaction. And so we had to evaluate the laws of 50 states. Judges had to basically deal with this for 10 years until it all worked out. It got worked out, but the people who lost the most were the people who didn't even see the issue at the front end.
That's absolutely correct. So if I was waving a magic wand on this, I would say the way in which a risk department needs to work is going to change. And the way in which I think it's going to change, as opposed to ChatGPT, which we were talking about this at lunch, is based on backward looking. You're now going to have to spending a lot of time about the forward looking process in a way that you do, for some purposes, interest rates, crop failures, floods, and all that kind of stuff, but you're going to have to think about all of these other competitive environments and their pros and cons, as well as the traditional risk, interest, credit, exchange kinds of factors.
I'm going to reorder slightly. Rick, how and why did Bank of North Dakota get started in venturing down the path of stablecoins? And could you please describe Rough Rider for everyone?
Yeah, absolutely. So as I mentioned before, Rough Rider is really for bank to bank. And so what we did was, when the Genius Act passed, we kind of sat around a table and we were like, hey, what is this? How do we move forward? How do we keep our banks relevant? And we had to come up with, what is the actual use case? Because I think, as I heard before, everybody got in this FOMO model, and they're still kind of in this FOMO model. They're really worried that they're going to miss out, especially in the financial space. And so when we were talking to our banks, it became very evident that people were like, yeah, we got to get into it, but it's going to be a while before this thing matures. And what we said was, well, if we can get a bipartisan bill passed in Congress today, that is probably not going anywhere. And so we got to figure this out. And that's when we started to talk about Rough Rider coin and what that all means and how we would use it. What we did know was we did not want to compete with any other financial institutions out there, which probably took consumer adoption off the plate. And we were like, that kind of gave a weight. But then we started looking at maybe the old financial rails that we had. And so maybe the best way to describe it is Rough Rider coin to us really isn't the mechanism of exchange as much as it's about building the infrastructure and the wallet system so that when other coins, as you guys mentioned earlier, there's 14,000, 24,000 coins out there, and we don't know which ones are going to survive. We've got other coins that are being developed almost on a daily basis out there, but the infrastructure so that our banks can handle those coins becomes very crucial. But then we said, okay, well, what are things that we see as maybe areas that could be improved, and how could we improve those? That's where we started thinking about our use cases, and one of them that came up was really bank-to-bank transactions. And what can we do around bank-to-bank transactions to make it more efficient? Maybe there's a way to add in smart contracts and tokenization of loans and participation payments or something like that. And so we ventured down that path of really looking at it. But we also know that regulation's still working out. Clarity Act is still coming through the pipeline. And so we're working on what that looks like and making sure that we have everything in place so that our financial institutions are prepared once these things get rolled out. And I'll go back to Rough Rider coin. While it is a coin, it's more about the infrastructure. And we phased it around, how did FedNow work out with implementation? How did RTP work out with implementation? Are there things that could be improved in there? And what we looked at was like a loan payoff. A loan payoff today at our financial institutions, either done by ACH, wire, or a cashier's check is cut. And that cashier's check is then ran from the business banker over to the other financial institution. Well, is there a way to help that out so that maybe we don't have the risk anymore of making a 4 o'clock deadline to get to the other bank? So that's where we kind of boiled down, okay, the first and immediate use case that we have, let's try this. Let's try a Rough Rider coin to really move the funds quicker and easily along those rail systems, knowing that the end financial institution probably isn't going to keep Rough Rider, that they're probably going to create fiat right away, but at least it gets them down the path of exploring these opportunities that are out there so that we can really put the rail system in place, because we don't know when consumer adoption is going to be. Now, some believe it's going to happen really quick. Some believe it's going to take a while. But we need to produce and provide for our financial institutions to be prepared when and if that day comes. That's why we got into Rough Rider coin, and we're starting to develop even more use cases around bank to bank. And even because we're unique and we're in the state, we're even looking at state government and how those funds could move between state government agencies and all of these different things. But we also want to bring our financial institutions in and say, okay, here's the list that we have. What do you believe that it could be used for as well? And do you have customers that want to use USDC, USDT, Bitcoin, and custody those things? And that's what the impetus is around kind of getting involved.
And two quick follow-on questions. So how formal is your approach to gather input from your partner banks in North Dakota? And then how do you go about building expertise across the state in this subject, or in the banks, or even in Bank of North Dakota?
Yeah, I appreciate that question. So the first thing that we did last fall was we ran our first, what we call B3 conference. And we're calling it Banking Beyond Boundaries. Because in this space so much anymore, it's not about the state that you live in or your local community. It's about almost the United States geography. And in some cases, it's about the global with cross-border and some of those things. So we got into bringing in experts from around the country in this area to bring to our North Dakota banks, because a lot of them don't have the budgets to go to all these conferences, especially around innovative solutions. We said, let's bring it to them rather than them going out to all of these. So we did that last fall. This spring, we're going to start our B3 groups. And what that is bringing in consortiums of banks or different areas of banks, bringing them in along with 4 or 5 different speakers in this area. And every B3 is going to have a different theme. This one in the spring is going to have stablecoins as the theme. But the next one after that is tokenization and embedded banking. Because we want to make sure that we're not just focusing on stablecoins, because there's other viable options out there in the banking that is just moving so quickly. You know, we always say the catchphrase fintech and kind of encompasses everything. And now it's encompassing stablecoins, cryptocurrencies, embedded banking, banking as a service, all these different areas. But even that, because when you look at community banking, some of them don't even offer online account opening right now. And we want to educate them all the way to stablecoins. That's a large leap. So we have to incrementally do this. We're also starting a podcast, 701 chain. It's fintech for financial institutions, for our financial institutions to stay up on what's out there. And that way, you know, they can see the other, or maybe behind the curtain of what's occurring, but they don't have to have all these upfront costs or conferences that they have to go to, have big budgets. And then we go around the state. So we just did our first FinTech Roadshow is what we called it. And we went out to the 8 largest cities in North Dakota, and we went to them instead of them coming to us. So we went and toured it. We actually didn't make it to one because of a snowstorm. They got a foot of snow, but all the other communities we made it to. And that's all around this education and making sure that they can understand what's going on, because it shouldn't be around FOMO. It should be about what are the practical use cases that you can see for your banks to utilize these? Or is it the question of what do your customers want? How do we get to your customers? And that's the way that we need to operate in the community banking space. Because when we looked around to those banks and we asked them this simple question, do you have customers today that are moving funds to Venmo, moving funds to PayPal, moving funds to Coinbase, moving funds to all these different areas? And that's nothing wrong, but we want the community banking space not to lose out on an opportunity here because everybody is trying to rush into the space, but to be educated and diligent.
Thanks, Rick. That's really fascinating stuff. I'm really interested in.
Can we come?
Yeah. Come to North Dakota? Yeah.
Oh,
What's that?
I said, can we come?
Oh, who come?
Me. Can I come?
Absolutely. Get my contact information. We'll get you to North Dakota.
Okay.
All right. So, Rick, you mentioned community banks several times. So, Amy, representing ICBA, you have a particular perspective on the implementation of stablecoins, where this is going. What do you see the regulatory process as? How do you see it playing out?
Great question, Tom. And we're sort of in the crunch period here for getting this all done. I will say, as a former regulator who did a decent amount of rulemaking, I have some sympathy for my former colleagues who are tasked with a very Herculean effort in a small amount of time. The Genius Act sort of sets up a race to the Federal Register. So the way Congress set up the effective date for the act is the Genius Act becomes effective either 18 months after the date of enactment, which was July of last year, or 120 days after the date in which a primary federal regulator finalizes one of their implementing regulations. So a lot of fun math for everyone, spending a lot of time on a dateandtime.net to figure out where all these dates are. It's been interesting to see sort of the rollout of this across the agencies, because this is not a one agency process. Everyone has a little piece of this. So if you're a bank and you have a sub that would be issuing stable coins, your PFR, Fed, OCC, FDIC would be supervising that entity. If you are a non-bank who wants to become certified as a PPSI, then the OCC would supervise you. And then there's going to be state frameworks for non-banks that are below $10 billion in issuance. So there's a lot of moving pieces here. And then in addition, Treasury is responsible for sort of quarterbacking this effort. People have talked about BSA. Treasury is responsible for implementing BSA, AML, the sanctions regulations, and how that would all work out, which stablecoins are interesting. A vanishingly few number of people actually interact directly with the issuer. You mostly are dealing with an exchange or digital asset service providers, as they're referred to in the Act. So you know, the BSA AML stuff is going to be rolled out across a very wide ecosystem. So Coy is going to have to be relevant to that, and you know, all of his colleagues who are DASPs. That's a lot of people who maybe had not been. I'm sure you are, but a lot of other people had not really been up to date on the BSA requirements. And I think all the bankers and their service providers in the room can all agree that's a very heavy burden to pick up and have to tackle. One interesting thing that our members are focusing on is, as people have mentioned, there's a risk of contagion as we bring payment stablecoins into the banking system. And so the FDIC is responsible for promulgating regulations regarding how depository institutions, particularly insured depository institutions, interact with and manage the risks that are involved here. The vibes can shift very quickly in the crypto world. So when you have a run on a stablecoin, and as Sarah Jane mentioned, those reserve assets can be held at a bank. What's the implication of that if you are the bank that's holding those assets? And similarly, if you're a bank that's banking those reserve assets as deposits, does that blow up your balance sheet? How does that impact your capital all requirements, all those types of things? So there are a lot of pieces here that need to be figured out. I would say, community banks are cautiously interested in this, exploring the opportunities. But as I've mentioned, there are a lot of things that still need to be figured out. And I think they're looking for some clarity from the regulators before they jump in with both feet. And at the same time, community banks are small enough to fail. So they don't have the benefit of the implicit guarantee that the largest banks do. So if something does go wrong, the repercussions for them can be pretty significant. So we are urging policymakers to really think through as we bring digital assets into the banking system. A lot of these safeguards are there from hard-learned wisdom and hard-learned lessons, and make sure the community banks and the customers they serve don't pay the prices. When things do eventually go wrong, knock on wood.
Thank you. Sarah Jane, in bank failures, how would tokenized deposits work as records of the claims of the depositors against the failed institution?
One would want to think that a tokenized deposit that was recorded in a ledger that the bank was operating would be treated exactly the same way. And I'd like to think that myself. I just don't know that it will be. So one of the issues that I hope we will all be talking about soon is whether a tokenized deposit will qualify under 1823E as a record that will survive in a resolution by the FDIC. I think it should be, but I don't know what requirements might be imposed for it to become that sort of a record. The interesting thing about a tokenized deposit is that you've got a public key and a private key. I may need Tom's hands. If you've got a public key and a private key, to rephrase my answer before, you maybe have enough to be a holder in due course, but what if it was hacked? And someone else has a claim on it. They actually might be able to do that. The someone else here is either a depositor or, remembering Philadelphia Gear, somebody who's trying to exaggerate the amount that is due to them under a letter of credit. It's not going to be quite the same as a letter of credit where the bank has an obligation that is handled in exactly the same way. So there are all these really geeky bank questions and really geeky state law questions and a few federal law questions that are required to be thought through in order to know how the bank will handle tokenized versus untokenized deposits. It may depend on what they know about the customer. It may depend on many other factors that all of which will factor into what would have to happen if an institution holding tokenized deposits were to fail. We'd all like to think that they're going to be handled exactly the same way if there are tokenized deposits. I don't know the answer yet.
Can I ask a quick follow-on? If hypothetically it was a a deposit through an organization such as Sam Bankman-Fried's that was held at a bank, and then that one went bankrupt, what might happen?
Loudly enough, because it's a fabulous question. One more time.
Oh, if a customer deposited tokenized deposit from an organization such as Sam Bankman-Fried's, and then Sam Bankman-Fried's company went bankrupt, what would the bank's responsibility, or what would happen at the bank in regard to that customer?
Is Helena Williams still here? Yeah. Okay, so how that would be handled in bankruptcy, which I teach only in a teeny piece in a secured transactions class, is something that has really not been dealt with yet that I know of. Even in that case, I don't think that issue was widely discussed in the papers that were filed. I'll now have to go back and look. What I find interesting about that question, though, is not when it's just a deposit, but whether it's a deposit in which someone else had a security interest that they could take not as a preference, but as their rightful claim out of the bankruptcy as the value it had this nanosecond that the bankruptcy petition was clocked in. That is a really important functional question, and one in which, as I say, I am not aware that that has been answered even in that proceeding, or in Voyager Digital, or in Celsius, or any of the other fairly high-profile cases. And there are very few of them, including Hashfast Technologies, LLC, out of a California federal court, as to what the value of the deposit was, which is an entirely separate problem and fascinating legal and practical question for everyone in this room to be thinking about.
You know, Sarah Jane, I view this question, which I think is a terrific, and it's probably the question, right? Because you're not going, and we're not going to find out till it happens, right? But it very much reminds me of the Washington Mutual problem, because in Washington Mutual, which occupied me, thankfully, for 12 years, and Bob Ledig and others, what happened is that the question became there, similar to here, that is, where is the money and who's got it? The question was there, who was responsible for the putback liability in the mortgage-backed securities? The FDIC or JP Morgan, which acquired WAMU. Interestingly enough, the 100-page agreement between JP Morgan and the FDIC was silent, right? So the court had to determine who in fact was responsible for that putback liability. I see that as being the same exact thing here. But the other thing I wanted to point out in terms of tokenized deposits is, and I don't see anybody, there's a few issues that nobody's talked about, and I want to raise them both, one with you and one with Peter. But if a deposit can be tokenized and moved around like a tokenized security, what happened to AML BSA requirements? I mean, you can't open an account at a bank without proving who you are and what you are and satisfying all these requirements, which you got to reclaim and re-sign every year. How do tokenized deposits fit into that world? I don't know the answer to that question.
Well, so the interesting question to me is how banks will struggle with the fact that they may not know who their depositor is. They know there's a public key and a private key. I don't know at the bank if it's taking it as a deposit. I presume they will have access to that private key. That makes it movable by others. But or hack on a bank. I hope we never have to deal with that. But these issues about who is your creditor for this purpose is an incredibly important issue. How, when suddenly that deposit is about to move, you know that you're not going to be violating sanctions, or you're not going to be doing something else that helps fuel a Mexican cartel. Those are incredibly important questions. The fact that the Genius Act mentions that the companies have to be capable of proving who the people who have interests in them are, for BSA and AML purposes, is a real step forward, at my view. I just don't think it's a step far enough. And so I think that the way in which, and I don't think we should wait for the bankruptcy courts to deal with this like you had with WAMU, but I think we're going to have to hope that some of the regulations that are coming forward will help answer some of those questions, assuming that they are low propriety, are those that Congress has asked them to
And
add.
if it's like WAMU, you will have two deciders, the bankruptcy court at the holding company level and the FDIC at the bank level, and they won't always, as in that case, agree, right? So Coy, let me flip back to you. If you ask anybody in the financial services business today, which has become a very broad swath of businesses, what regulation should look like, everybody has a different answer. The banks would say, we want you more regulated. I guess you'd say, you don't want that regulation. In the real world, what do you think is the right place to come out in terms of future regulation with respect to your views and your business?
Yeah, so we welcome regulation. We actually are asking for federal regulation.
Yeah,
of
everybody
spot
says
crypto
that till they
trading.
get it.
No, we certainly have plenty of experience
It's
on
usually an
other
opening
lines of business.
negotiating position,
So
right?
we're obviously heavily regulated by the SEC and FINRA for our brokerage business. We have a derivatives business regulated by the CFTC. So we understand what it's like to be
Right, but
overseen
there's
by
a big
markets
difference
regulators.
between all that disclosure regulation and prudential regulation. Nobody tells you
Without
how
a
much
doubt.
capital, liquidity, when to go to the bathroom, all that stuff.
Without a doubt, yes. Banking is its own animal.
Right.
But for us focused on the crypto business right now, we are fully supportive of the Clarity Act that's being negotiated in Congress right now, right? And the reason why we are fully supportive of it is it marks very clear delineation of CFTC would be the primary regulator over spot trading of crypto. The SEC would retain some authority over certain assets that fit within their jurisdiction. And there's a process laid out in the bill that would make it crystal clear this is which regulator you talk to in that given time. So we think that is important for the industry as a whole. I think the industry largely is supportive of that. I think it's gotten to the point of the industry has matured a lot, I think, since the early days, right? So I think that is an essential next step. The Genius Act is incredibly important for stablecoins, but it's just one segment of the industry, right? I think the Clarity Act is really important because it will unlock a clear regulatory path, which will allow other intermediaries that are looking at this and saying, hey, I have customers interested in this, but I'm perhaps scared to get into because there's not a primary federal regulator. I think bringing that rigor and transparency and discipline that comes with being SEC or CFTC regulated is really important, and we're advocating strongly before Congress to get it.
Let me
Is that because of legitimacy with customers? Is it cost savings with different regulations and the overlaps, et cetera, or is it legitimacy with customers, or is it a little bit of both?
Certainly a little bit of both. I mean, we have millions of customers we have tons of legitimacy with that want to trade crypto now. They could care less if we're regulated by the SEC or the DFS as the primary regulator, right? But I'm sure for some that are sitting on the sidelines, that may be a concern. From a compliance standpoint, it is difficult to comply with 35 to 50 different states, depending on the money transmitter licenses and everything like that. We love all of our state regulators. We're happy to do so. But having the federal oversight would streamline the compliance efforts for companies without a doubt.
Yeah, talk to the banks that make mortgages in all 50 states about complying with 50 state rules. JP, can I ask one last question here? Because I'm dying to ask Peter something that I'm recalling now from our days in the 1990s when we were dealing with what they called electronic money then, right? Mondex, DigiCash, there was a few other things, which is basically an account at a bank that was reduced to a smart card that you could put into a wallet, transfer peer-to-peer, all that stuff. It was supposed to be the money that would take over financial services, and within 3 years it had disappeared. And what survived was the digital signature that became the blockchain. So I've always argued, look at the underlying technology, because that's what may survive as opposed to the product. But you and I and Bob discussed at that time when we were working for several clients, the threat of replication, right? Because all of these digits and dots and all this stuff can be replicated. And people say, well, the blockchain is immutable. Not true. It is just not true. $14 billion of crypto cash has been taken by hacks over the last 2 years. 14 billion. That's more than all the bank robberies in the history of the country, right? So don't tell me blockchain is immutable. I mean, somebody's breaking it and somebody's getting through. And if quantum is real, quantum computing is real, the blockchain will be invisible, right? So the question I have for you is the threat of replication real here? I mean, that is, if somebody figures out how to replicate stablecoins or replicate Bitcoin or anything else, they can flood the market overnight, nobody will know, cash them in and walk away with all those chips, and the system collapses. So from your perspective as a technologist who understands how this stuff works, I only read about it, I don't know how to code, what do you think about the threat of replication either now or in the future?
So, way back in the 90s when we were first talking about it, the idea that someone could make a perfect copy of a digital bill, a digital banknote or digital whatever, was such an obvious issue that it's been the defining problems that people have always tried to work their way around and stop and prevent, because you need to have scarcity for money to work, has always been the idea. I think your basic worry about there being some crack that people get into either somewhere in the system, is a valid one, and it's one we worry about. And, I think by the way we've insured it with the old system is that, we've got the Bureau of Engraving Printing tries harder to make sure you can't counterfeit things. If the crack were big enough to really undermine one of the different blockchains that are out there, or the Bitcoin or something like that, well, it would be devastating for the people who own it, and for everybody else, they might be laughing. I think people have tried really hard to prevent anything going wrong, but the best laid plans.
Yeah, and if I don't know what the chances are of replication, because it hasn't happened yet, right? Or at least not that I know of. But if it does happen, remember now, we're in a decentralized organization. There's nobody there to help, right? You don't turn around and say, oh, this got replicated, bail me out. I mean, that's it, right?
Well, this is one of the weird events that I think anybody here should study, which is what happened with the Ethereum blockchain. And on the Ethereum blockchain, where the people were building these things, these distributed companies, basically DAO. And someone created something, and it was like a distributed venture capital fund. And someone figured out, they looked in, and they looked at the code, and they figured out a loophole. And they found a way to basically take all the money. Now, if you're a blockchain purist, what they did was they followed all the rules. They did everything correct, and at the end of the game, all the money ended up in their account. But what happened was everybody was so aghast, they're like, oh my gosh, this will completely undermine the belief in Ethereum. So there is like a small cabal of people at the top of Ethereum who controlled enough of the mining process that they said, we're going to go and we're going to roll these transactions back, and we're going to pretend they never happened. And so this is really important to understand, is because it completely undermines the notion that the blockchain is immutable, which is what you talked about. And then in this case, it speaks to your question, is anyone in charge? Well, in this case, these nerds just came together and they said, look, Ethereum is our playground, we like it, we control it, we need to make sure it works as best as it can, so we're going to do this is what we think is the right thing. And it's kind of the same thing as the Federal Reserve Board meeting and saying, we're going to bail out this bank and not this bank, or I guess it's the FDIC or whatever. But,
Yeah.
So there are people there, and at the deepest level, it makes it look like quicksand.
Yeah. JP, I know we're coming up on our world famous donut networking segment, but maybe we should take one or two questions here.
Yeah, that would be great.
Do we have any questions for this illustrious panel? This has really been, I find this intriguing stuff, but I think I've always thought that the unanswered questions are the ones that are most important to look at and think about. Over here.
Okay.
Paul.
From a market standpoint, when I take a look and read the commentary, I hear that basically the larger banks are going to say, we're going to have a digitalized or tokenized type of account. And we think that we're going to be able, from a market standpoint, to beat anybody else because we're going to be able to say, I have FDIC insurance. Now, with all the questions that are being asked here, and this is way above my technical level, do those questions need to be answered before those people who are making that commentary say that can be an effective market strategy?
Who wants to take that?
Well, I mean, I think it's important to distinguish between tokenized deposits and payment stablecoins. They operate somewhat differently. To your point,
Well, but any tokenized asset that is outside of the banking system. So if somebody wants a tokenized asset,
Yeah, so your original question was about tokenized deposits, and I think for that, the question about whether it really works is the interoperability. This is the issue for this proliferation of different asset types. If you are JP Morgan Chase and you can have your walled garden, you're big enough, you can probably make that work at your scale. But for an individual smaller bank to have their own tokenized deposit system, if it doesn't operate in some sort of consortium model or with some sort of other clearinghouse mechanism across other banks, then it's a really limited utility. So I think it's going to be interesting to see how that develops here.
thank you.
Question
That's
over
my
Yeah,
clients.
Rick, would you have a comment on that question?
Yeah, absolutely. I think the struggle I have is much like what was just said, it's a consortium model versus each individual having their own coin. And so when you get into these smaller banks, is a larger bank going to accept the deposit token of a smaller bank? Are they going to believe that, let's say that they have $5 million that they want to send to a larger bank? Is the larger bank going to accept that from a $25 million bank? And that's the struggle I have if we get into the point that everybody is accepting deposit tokens and all of those different things and creating those deposit tokens, or is it better to have a consortium model that we see starting to be started up, like Carry Network and us at BND and all of these others, where you're having these kind of set up around the country, and then they're acting as the intermediary or the good funds model that is saying, oh yeah, these deposits are good deposits.
Yeah, Rick, that's a great statement because it suggests that where we're going back to is 1830, where the big bank will say, I'll accept it, but at a discount, right?
100%. And honestly, you have to, because you have to cover the credit risk, right? That's a whole portion of interchange fee income, of ACH. It was all to maintain that all the funds that were being processed were good funds. Now we're in this instantaneous model. How can you have good funds and be certified with good funds if nobody is certifying that as a third party?
Let's get that question in, Sarah.
Okay,
We got one question there.
Yeah, thanks so much. I really appreciate the panel's perspectives here. Dan McGonigal, I'm in regulatory compliance with Crow, but former Fed. I guess my question is probably directed to Peter, but happy to hear the panel's perspective. We hear a lot about financial crime and illicit finance being perpetrated across digital asset activities. I don't think that that's a problem that's exclusive to digital assets. Verafin released a report last week that's actually quite interesting that suggests that illicit finance and fin crime is growing at a rate of 20% per year, and that's on traditional financial systems and legacy platforms. So I don't think it's exclusive. What I want to hear is perspective on how the blockchain and digital assets can be used to combat this problem, specifically thinking about things like traceability, token extensions, permissioned networks, and how on-chain analytics and other tools can potentially be used to help combat illicit finance and not just allow for it.
Or AI, right? AI preventing
Certainly,
crime.
yeah.
I mean, I think the big difference is that a lot of these platforms are very open. And when you watch how the Doge revolution proceeded and things like that, a lot of it depended on making information available to the public and hoping that someone would identify things. And one of the things that I find really surprising about the Trump administration is that you will see people tweet something and they'll say, oh my gosh, this is horrible. And then you'll see the person who's in charge of it in the Trump administration saying, hey, we're on it. So I do believe there's the potential. You see that there are people who are willing to devote their time to exposing these things. And I think the deepest problem is whether the government with the real ability to punish people is actually going to do anything about it, and that, whether they have the resources, et cetera.
One last question, and then donuts.
Yeah, I think the question is around what this does to us as a society, kind of taking a step back, and we think about you have all of these different coins that are out there, and if you don't have consortiums or interoperability, where does trust get lost? And so how do you navigate that just as a society writ large? Because we've talked about, you know, before in the 1800s, it's all kind of dispersed, and then you've centralized things, so there's good trust now that's built, and then you have that trust kind of get, you know, bifurcated in all these different spaces and directions, and what do we do with that as a society?
Well, interoperability is sort of a two-edged sword. I don't know, Sarah, if you want to take this or who, but interoperability is a two-edged sword. Interoperability makes systems work coextensively with each other, but the reason that an adverse nation can't turn off the lights in America is because systems are not interoperable. So you tell me when you want them to be interoperable and when you don't want them to be interoperable, right?
I meant to mention this earlier, but it's way better in response to your question, which is one of the issues with a large number of payment stablecoins or whatever, is that just as the Bank of North Dakota is worried that its small banks' tokenized deposits will not be taken by larger ones, what we have had since we got the Federal Reserve, or perhaps even the greenbacks, is that we had a method of determining that we could trust it. And that this is a step away from that method. And while I'm on this question, I also meant to mention this earlier. If you have a tokenized deposit and a smart contract hanging on it, I don't think you're ever going to get a holder in due course treatment. And the reason is that you cannot have a condition to payment in a payment instrument because it destroys negotiability. So we may not have fungibility, Bank of North Dakota's problem, and we may not have holder in due course status, which my friend at Columbia, Ronald Mann, thinks died years ago. I do agree. And the mortgage foreclosure problems showed me that I was right and Ronald was wrong. But the two issues of fungibility and right at a high level, not subject to claims, are two of the devils that still have to be worked out.
Okay, I think we have probably expended our time. This has been terrific discussion, and I'm sure we could talk to this panel for another 2 or 3 hours.